I want to start off by taking a quick audience poll. Who here, for their primary bank account, uses one of the big banks? Wells Fargo, Chase, Citi, Bank of America. Who here uses a challenger bank or startup bank for your primary bank account? All right, a few. I guess that they kind of highlight some of what we're talking about in terms of the big banks serve a certain amount of customers. I mean, clearly, I don't think we can pretend that the crowd here is representative of the America middle class in general. But let's start with you, Chris. Chime, you now have 4 million accounts. That's 4 times as many as you had about a year ago, I think. You're the first U.S. challenger bank to reach over $1 billion valuation unicorn status. And I think you're adding now, 250,000 new accounts per month? Mm-hmm. By comparison, I looked it up, Wells Fargo is adding 200,000 new digital accounts per month in the first quarter of this year. Why has it taken so long, though, to have any challenger banks, and why is it happening now?
Yeah, I think you're right, and not surprised to hear that a lot of the folks in the crowd today aren't using challenger banks. We target everyday Americans, mainstream Americans that are fed up with a lot of the fees that Andrei was speaking of. And we provide, the mission of the company is around providing financial peace of mind. There's a tremendous amount of anxiety in America if you're a middle-income consumer, and big banks generally are not helpful in that regard. So I think I agree with the notion that the smartphone changed everything, and the fact that it's ubiquitous, and that the days of needing a bank branch to help with distribution are over, particularly for a younger consumer segment. And our members are really, what's resonating with them is a real-time, modern, mobile-first bank account that doesn't charge fees, doesn't rely on fee income, makes everything fast and easy. We give our members their paycheck a couple days early. And we really target a consumer segment that pays with debit cards. And I imagine all of you in the audience pay with credit cards because you've got enough balance and income to be able to pay that off each month. But the reality is that in America, more than half of transactions each month with cards are done on debit cards, not credit cards, which is usually a surprise. So we're really targeting that segment, and it's a really big segment, and we're really excited about the traction that we've gotten.
But why now, though? I mean, why did you decide that now is the right time that you're opening to do this?
Well, I think the cost of starting technology companies has never been lower, and the funding environment is obviously extremely strong. So we were able to, we look at ourselves as a technology company that happens to offer financial products. So by building the full tech stack from top to bottom and creating a consumer experience that people really love, we're able to offer products at a very low price. And so that's resonated with a lot of people. And at the same time, there's been this backdrop of all the controversy and some of the practices from the larger institutions that have gotten a lot of headlines over the past few years. So I think we just happen to be at the right place at the right time with the right team.
Ken, Credit Karma tracks, you get free credit reports to consumers, so you're seeing a lot of data in terms of credit scores, of many Americans, I think primarily millennials. But I'm curious, what trends are you seeing? I know we're going to hear from SoFi later, and in order to be eligible for SoFi refinance or loan, you have to have a credit score of 680. But how does that compare to kind of the averages, and who is being left out of some of the new fintech services that are available?
Yeah, so as a platform credit card, I mean, we're not a challenger bank. We think about being a champion of the consumer. We have approximately 100 million members on our platform now. And the general trends that we see is that they oftentimes are left out. So for example, when you think about thin files and their inability to get credit, when you think about who is serving the millennial customer who might only have $5,000 but is thinking forward about saving for their future, right? I mean, no one's going after that segment. And our point of view, and I think pretty much aligned with everyone on the stage, is that banks need a forcing function. Banks need a large group of people who actually say they want change. They don't want another way to pay for a cup of coffee. They want another way to actually get the very best rates. They want a platform that doesn't charge them exorbitant rates to save for their future. And those are the trends we see, and I think that's very much aligned with the lack of trust in the industry as a whole, because they're not seeing that transformation. They're seeing much more around, well, how do you lower the cost of interchange? And that's not a consumer problem. Again, that is a bank problem. And I think millennials and users as a whole are fed up with the system.
You mentioned nobody's going after that segment, but I don't know if that's quite true of the other panelists. I mean, Luvleen, what segment are you going after in terms of BankMobile?
Yeah, for us, it's low and middle income Americans. That covers, a large proportion. But you asked about like why now, and it's very obvious that consumer needs and behaviors are rapidly changing, and banks are really slow to adapt to that change. We're seeing Americans living paycheck to paycheck, a third of Americans doing so. 50% of Americans don't have enough to pay for a $400 emergency, and these same Americans are being charged $34 billion a year in just overdraft fees. That's more than what they're paying for vegetables. And so we're not only improving the consumer experience from affordability, from technology, innovation, more consumer-friendly products, trust, but we're also shifting the business model, where acquisition is branch-based historically. And banks are opening one net new checking account per branch per week. That's it. And today, we're opening 10,000 accounts per week using technology and really creating a consumer-centric product that they're looking for that really addresses their pain points.
One product I think that when I talk to both you and Chris that people really like is debit cards, which surprised me a little because in order to build credit, in order to increase your credit score, debit card isn't really serving you. How do you think about that? I mean, how are people who, if they like using debit cards so much, how are they going to increase their credit?
Well, I think it's important to help them with debit and offer them, an opportunity to help them grow their money, save their money. But we're not ignoring credit. I think that's one huge pain point. Our customer base is thin credit file and also low or near prime. And so we're focusing a lot on helping them build credit through products that we're offering, and also from an education front to make them understand, there's a lot of really savvy people that don't even understand the components of what makes up good credit score. And so there's a strong educational and coaching experience that we involve as well to make sure people are ready to take on credit and build that credit.
Do you want to add that to something there?
Yeah, I mean, we've done a lot of research on this, and what we found is that pretty much everyone in America knows their credit score, thanks to you. And the problem that they have is they don't have great ways to improve that. So we're very focused on, today we've been focused on the checking account, savings account, but we know this is a big need among our consumers. They want to eventually qualify for credit and be able to, buy a home and be able to get a mortgage and so forth. So late last year, we acquired a company called Pinch that's in the credit building space, and we'll be launching some additional products in that area in the very near future.
Ken, how about you? I mean, now that you know people's credit scores, you've made them aware of it. Is there anything that Credit Karma could potentially do to help people increase their credit, or to get into some of these banking services?
Yeah, well, if you think about Credit Karma, I mean, we're a lot more than a credit scoring site. I think more than more, we've really moved into people's financial identity. And as we talk about acquisitions and mobile acquisition, the opportunity that we see in this space is that as a consumer, it is painful to apply for any given product. And it used to be you go to their branch, but I think there's still a good amount of friction associated with either opening a bank account or applying for credit in general. And our point of view at Credit Karma is we have the financial profiles of 100 million consumers, and we can simplify that process. And I think to answer that question directly, I think there's an opportunity for us to determine, well, with any given financial profile, we know whether you are the best type of customer for Chime, for Bank of America, name any financial institution. We understand that consumer's financial profile with that of the target audience, or maybe of the target of a banking partner. And I think that's the opportunity for us, is to take out friction out of the way that consumers look for, shop for, and get the best rates in the financial services market.
Mm-hmm. So potentially more products down the road that we might see from you?
Well, definitely. I mean, I think we started on the credit side, which I think historically has been really challenging in the sense that it's hard to get access to this information. But I think over time, we've had three pillars on our business. We think about helping people find the very best in the borrowing side. We hope to help our members find the very best in the yield side, so in the savings and asset side. And lastly, insurance is really the three categories that we think about. If we have your financial profile, we should be able to put you into the very best product, given that we know your cash flow, your income, and your liabilities.
I'm going to come to the audience soon for questions, so get them ready, raise your hands, and we'll get the microphones to you. But in the meantime, one thing that I know is very important to both of your businesses is you don't charge fees, no overdraft fees, no monthly account fees, no credit card fees. If you're going to do that, I mean, how committed can you be to that? This is what this has been the bread and butter of banks for so long. How can you go up against the big banks, without charging these fees? And doesn't that just make you much, much less profitable than traditional banks have been?
I think we have a very strong position relative to traditional big bank competitors. Do you know how much it costs to have a savings account at Bank of America if you have less than $500?
How much?
$8 a month.
Oh.
That's the current price. And it costs $12 a month for a checking account if you don't have a large direct deposit or a big balance. So that's the segment we're going after. And by the way, that's a huge portion of America. I mean, you were citing the stats of, something like 40% of Americans don't have $500 in a savings account. So it's a huge portion of America. And there's an opportunity to service these people far more efficiently by not having a big branch infrastructure and having modern technology that isn't mainframe, batch-based. Everything's real-time and easy. And so we think there's a great opportunity for delivering in a very sort of Amazonian way, figure out ways to delight the consumer and wake up every morning and try to figure out how to reduce fees. That is not the way big banks, that's not what they think about when they come to the office each day. Because if you look at, a Bank of America or a Wells Fargo earnings call, every analyst on the call is asking about how did fee income do last quarter? And I'll tell you how it did last quarter. In Q1 of 2019, the top 3 banks earned between $1.2 and $1.6 billion of service fees on deposit accounts. That's our opportunity.
Can you be profitable doing that?
By not charging fees? Well, our model today is primarily, it's almost entirely interchange. So we make money when the card gets used at the point of sale, whether that's a swipe or an Apple Pay transaction. And what's great about it is there's complete alignment with the consumer. We only make money if the consumers engage with our product and using it as an everyday transaction mechanism. So we are very motivated to get them excited to use it and use it for a cup of coffee or a big purchase at Walmart or Amazon. So we're excited about being able to monetize in a way that is very much aligned with the consumer's interest.
But yes or no, do you expect to be profitable long term?
Of course.
Okay.
Yeah. I mean, we could be profitable today if we weren't investing. Literally, we could be profitable this month if we weren't investing so much in brand building and customer acquisition efforts on television and a lot of the marketing channels, as well as the investments we're making into getting our consumers to refer their friends and so forth.
Good, yeah.
So we're really focused on profitability. We're actually right now, part of a public company, and so banks. We're FDIC insured, we have a charter. Banks are valued on profitability. So we have no choice but to create a model that's going to lead us to either equal to or greater than profitability of a traditional bank. And how are we doing it? We're really focused on high volume acquisition and at very low cost. And so today we're acquiring our customers at essentially close to $0. And we're doing it at very high volumes. And the way that we're doing it at high volumes is that we've gotten into a B2B2C model, or banking as a service. So historically, B2B2C could have been, bank to branch to consumer. Today, we're doing it bank through business partner to consumer. And so today, in the higher ed space, we have relationships with 800 campuses across the country, and not in a relationship where we're paying them millions of dollars to be the sponsor in their arena or a branch on campus, et cetera. But we're solving a pain point for them to transfer payments to themselves from themselves to the students. And we get to then have a choice for these students to bank with us. And 1 in every 3 college-bound students sees our account and has the chance to bank with us. Similarly with T-Mobile. T-Mobile was looking to get into financial services. They want to create more touch points, more emotional connection with their customers around the mobile experience. And they're doing that today through T-Mobile Money, which is a new checking account that we helped them launch. And so through our partnership, we're again acquiring customers at relatively low cost and high volume.
Yeah. Was there a question over here? Did I see one in the audience? Questions? Cliff, Leaf, editor-in-chief of Fortune.
Hi. In March 2009,
Hold on one sec, the microphone, yeah.
Oh, thanks. In March 2009, Citigroup's market cap fell to $6 billion. You could buy a share of Citigroup for 97 cents. This was down from about $277 billion just a few years before. This was the depth of the financial crisis, and yet the government, for good or bad, stepped in to save Citigroup, Bank of America, a whole host of others. I think what people are concerned at is that if there's another financial crisis, there will be no rescue of challenger banks, banks that we just learned their names. I mean, there's a reason why banks in the old days had those big Greek columns in front, those imposing faces. It's because it was supposed to say trust. And so can you speak to that issue about whether people will feel confident if there is another crisis that that somehow their money will be safe in a challenger bank?
I would be happy to comment on that. I think that banking with Chime is very safe. We don't operate prop trading desks and are in a bunch of exotic investment instruments that a lot of these big institutions are. And I would argue that the country is not in a better place given what's happened over the last 20 to 25 years, where, if you look in the early 90s, the top 5 banks owned something like 6 or 7% of deposits in America. Today, it's over 55%. So I don't think that that's a good thing for our country when you have such a tremendous amount of concentration. And I would argue that regulators are probably interested in trying to create more balance in the world so you don't have another too big to fail situation. And I think companies like ours and many of the others, I think, have an opportunity to create large, enduring franchises that are more consumer-focused, more technology-oriented, and really have the best interests of our consumers in mind. If you look at the way that traditional banks price their products to everyday Americans, at their core, it's adversarial. It's all fee-driven, and I think we are well positioned to weather a storm. We're not even into credit and lending yet.
Ken, I know you started your company in 2006, so I'd love to hear your perspective on that, with the added insight that you get from looking at so many people's credit scores, or at least checking the trends.
Yeah, I mean, our general perspective is that we tend to be consumer-centric, and our point of view is we're not sure whether the traditional banks or the challenger banks will win, but what we want to provide is a platform of choice. We want to provide a platform of discovery. So, whichever company has that best service, that lowest price, that best brand, that most trusted brand, we ultimately think about our job and our opportunity with our membership base is to help consumers discover that. So we tend not to have a skin in the game other than we want the best choice for consumers and the most low cost and most advantageous products.
Yeah, and one thing that we haven't covered here, I think one of the things that we should all be very cognizant of is just cybersecurity and fraud. So it's not just about another financial crisis, but how are we making sure we're creating robust systems where we're not going to be penetrated? Because I think that is the biggest risk to consumers in this new digital age.
One thing I'd love to hear from each of you on the minutes that we have left is, so you're going up against big banks, like Cliff said, these are, tens of billion, hundreds of billion dollar companies, huge, and they control 55% of the assets in the US. So, what do you find harder? Like, what's the toughest nut to crack? What do you find, the biggest challenge to innovate upon? What is hardest to do better than the big banks for you, Luvleen, for example?
Yeah, I mean, I think that the table stakes are not even being addressed today. So if in terms of just opening a checking account, consumers want to do it in 3 to 4 clicks in 2 to 3 minutes. And I don't think that I'm looking at the big banks that have 50% of the deposits today where I can say with full confidence that's happening. We're doing it today. 2, consumers want to be paid on their money. The large banks at most checking accounts are give 8 basis points. Today, through T-Mobile Money, we're able to do 50 times that with 4%. Consumers don't want to be charged exorbitant fees. I was talking to a partner of a VC firm yesterday, and she said that she's being charged the monthly $12 fee for banks, and look at the echelon of society that she's in. So I think that there's a huge opportunity for them to continue to innovate. They have dollars to put behind technology, but I'm sorry to say, but there's so much room that we're already sort of competing with them on with table stakes not being addressed.
Yeah, what do you think, Ken?
Yeah, I think similarly. When I look at the consumer base, consumers can't determine whether they're eligible for a credit product until you apply, and you have a 50-50 chance on average of being declined. That's bad in an age where we can call a car and drop us off at the airport in 2 clicks of a button. We can't figure out something as simple as that. I think those are intrinsic problems. I think the spread of interest and the sort of the opaqueness of what it means to borrow or save. I mean, how do you determine the best rates or how do you determine the worst rates? It's kind of impossible today, and I think it's only scale and maybe through the work of the panel up here that we can motivate the industry to go forward and think about it from a consumer perspective rather than a fees perspective or a bottom lines perspective.
Yeah. What about you, Chris? What's hardest to do better than
I mean, I think our biggest challenge and opportunity is really just to break through. Most consumers in our segment tend to have accounts at Wells Fargo or Chase or B of A because their mom opened it up for them. And so I think we're really leading the charge here in the US in terms of creating awareness that there actually is another way to do banking. You don't have to do it through the physical branch infrastructure. And so our opportunity is to to try to break through and share the fact that there are other opportunities and other options. I don't think it'll just be us. And so I'm excited about what the future holds for us in terms of creating an entirely new category that's actually helpful and doing right by the consumer.
Yeah. Well, that's a good note to end on. Hope you guys keep up doing right by the consumer, even as you get bigger. So thank you all for being here.
Thank you.
Thank you.